Welcome back to Anarcho Markets, where we explore the real drivers behind crypto, DeFi, and free markets. Today we're diving into some serious risks facing Bitcoin's future. Whether you're a believer in decentralized finance or just curious about crypto, understanding these risks is crucial. So let's break down what could impact Bitcoin's journey toward financial freedom. First up, quantum computing. This emerging technology is advancing fast and it has the potential to undermine ECDSA and SHA-256, the cryptographic systems protecting Bitcoin's network. But here's the thing, it's not just Bitcoin. Virtually all banks, and even your personal computer, use the same cryptographic methods. If a quantum computer with enough power to break these encryption standards appeared, banks would likely be the first target since they control far more money. So, is this a high risk for Bitcoin right now? Not exactly. Quantum computing is still in its early stages. Most experts agree we're years, maybe even decades from this kind of attack, and Bitcoin developers are already working on quantum-resistant alternatives. So, while it's something to keep an eye on, the risk remains low for now. Now let's talk about big whales and institutional players like BlackRock. Recently, there's been speculation about institutional interest in Bitcoin forks. Why is this risky? Well, large players have both the financial power and influence to propose forks that challenge Bitcoin's core principles, such as scarcity. Back in 2017, we saw a split between Bitcoin and Bitcoin Cash over issues like block size and scalability. Big whales supporting a similar fork today could threaten Bitcoin's decentralization by pushing an agenda that favors their financial interests over the communities. Imagine if institutions pushed for a fork that diluted scarcity by increasing the supply. With their massive capital, they could manipulate the market, making it difficult for retail investors to resist their influence. This risk isn't imminent, but it's something to consider as more institutional money flows into the space. Next, let's talk ETFs. While ETFs can bring Bitcoin exposure to traditional investors, it's essential to know that buying an ETF is not the same as buying actual Bitcoin. When you buy Bitcoin directly, you own the asset, meaning you can withdraw, store, and control it entirely. But with an ETF, you're buying a financial product that represents Bitcoin rather than holding Bitcoin itself. This comes with different risks. Some ETFs might not have a true one-to-one fiat to Bitcoin ratio, meaning the company behind the ETF may not hold the actual amount of Bitcoin to back the shares they're selling. This allows them to influence prices artificially, creating a disconnect between the Bitcoin market and its underlying value. This type of setup could lead to volatility and manipulation, especially if major players decide to buy or sell in large quantities. Finally, let's touch on other risks. Government regulation could impose new limits on Bitcoin's use, especially in places looking to control decentralized finance. And environmental concerns continue to hover over Bitcoin, with debates about mining's energy consumption. If Bitcoin faces more pressure on environmental grounds, it could push for changes that dilute its decentralized nature. We see this as a minor risk because of the number of mining farms running all over the world. So, to recap, we have quantum computing, institutional influence, risky ETFs, and regulatory or environmental pressures. Each poses a unique threat to Bitcoin's future, but together they shape a rough landscape. We still believe that Bitcoin is the solution to many of today's problems. At Anarcho Markets, we'll keep a close eye on these developments because the future of freedom depends on it.